While most investors are losing money treating the stock market like a sports betting app or a prediction market, there's a group of individuals who are making money off the literal backbones of our economy. Steady, cash flowing assets that make money and they go up year after year. So why are so many people losing and others are winning? Data from the Dalbar quantitative analysis of investor behavior shows that retail investors consistently lose, often by 3 to 6% a year, for making trades at exactly the wrong time. Last year they got close. It was the best year since they've been tracking the study, and still they failed to beat the S&P. Some investors are chasing moonshots. They're up 1,000% in a year. Why don't we talk about the boring 10-15% compounders that are actually making money? I'm Marcus, and this channel isn't about chasing quick doubles and triples, although when the market presents them, we take those opportunities. This channel is about looking at holistic wealth management. It's about understanding the fundamentals of business that actually drive stock price gains. Everyone knows that time in the market is more important than timing the market. People are people. They get caught up with emotions like fear and greed. We need to let stories and macro events be left for the professional traders. We need to compound money over time, slowly. Most importantly, we're going to look at the habits and psychology that shape how money is made, how it's spent, and how it's enjoyed. We care about investing, but we care about how our daily lives fuel that as well, for better and for worse. So if you're new here and you want to follow along, I'm also going to be sharing my story, my journey. Everything's going to be transparent. Consider subscribing, and let's get into it. So a quick delineation, we're not talking about trading in the stock market. We're talking about buying and holding quality businesses and then looking at how those fit into a holistic form of wealth management. As opposed to looking at price momentum and hype, we're going to look at business fundamentals and cash flows. Our time horizon is years and decades, not minutes, hours, and days. Our risk focus is avoiding permanent capital loss. It's about concentration. It's about understanding where there is risk and there is reward. And we want that too, but we can't have that portfolio go to zero and start again. This isn't the casino. That's why we care about risk-adjusted return and not just the percentage gain and loss. So who am I to say this? I've got a university degree in accounting and economics. I've spent the last 15 years slowly building a multi-6-figure portfolio. I've actually learned more about what drives the stock price up by the last decade working in and founding my own startups. I've done everything from commercial fishing to software as a service for multinational banks. I've been employee number one at a startup, helping to secure funding. What do those investors care about? It's a little bit different for venture capitalists. I went to New York to spend time in incubators, and I've gone on the road selling. More recently, in the last 6 years, I've been in wealth tech. So we're actually building technology that professional wealth managers use in their everyday life. This is from operations all the way through to compliance. Let me tell you, there's a lot to learn about risk management from compliance. Ask any professional head of a bank or professional investor. They care about risk management because it's not just how much you can make, it's not losing. This also opened my eyes up to how professional investors actually manage money. They think about wealth management, not picking individual stocks. Think about an entire portfolio. What's the asset allocation, the geographical diversification? How concentrated am I in a single security or a sector? They think about a client's ability and willingness to take on risk. They think about their time horizon. They put this all together into one big picture. And that's just for the investment side. There's tons of other pieces to the pie that I want to uncover and share on this channel. Listen, I am not a financial advisor, and none of this is financial advice. What I do have is an education, a lived experience of how to build and scale businesses that ultimately drive stock prices, and a track record and experience of beating the market. I've made every beginner mistake you can, from chasing high yield and dividends to thinking that this next story was going to go to the moon. This isn't about that. What I've realized is that it's the boring businesses that compound consistently over time that truly generate wealth. You can expect 3 core content pillars on this channel. First, the financial foundation. This is personal finance and investing content focused on behavioral psychology, money habits, Canadian-specific accounts like TFSAs and RRSPs, and distilling the principles of super investors such as book reviews and mental models. 2. My portfolio journey. Transparent and realistic documentation of my own wealth building. This includes net worth updates, the mechanics of moving from 0 to 100,000, 100,000 to 250, to 500 to $1 million and beyond. Strategies for maximizing human capital in your first 10 years of building up your army of dollar bills in your 20s and 30s. Finally, 3, the equity desk, my personal favorite. Fundamental stock analysis, growth at a reasonable cost methodology, sector and industry breakdowns, reviewing key financial metrics, and level-headed coverage of market-moving news stories like the SaaS-pocalypse. So what should you do? Boring is best. If you're not willing to put in the work and dive deep, then I think this channel is still okay for you because you can learn from the habits and the money psychology. Go dollar cost average into index funds, put 10 to 25% of your money in those every month, and you will come out a millionaire. But if you are like me and you want the confidence in the fundamentals of your portfolio, then here's what we want to dive deep into. It's logical, it's pragmatic, and you don't have to be a professional to understand it. We want high quality companies. We want strong fundamentals. They're profitable, they're growing, they're non-dilutive with the share issuance. We like insider ownership and high return on equity. We want these businesses to have a moat, and most importantly, we want them to sell at a fair price. It doesn't have to be excellent, but it has to be fair. We care about asset allocation, the types of securities and asset classes that we're going to be actually invested in. This is cash and equivalents. This is fixed income, equities, alternatives. Hey, for example, do you know how much your portfolio or how much of your expenses that you should have in cash and equivalents that is accessible to you in a liquid account? Well, you should have 3 to 6 months of your expenses. That all breaks down from knowing those numbers and from knowing your budget and being able to add it up and knowing that you can access it because it's in an account that you can withdraw from. And don't just leave it in cash. Put it in at least a money market fund. If not something a little better like a treasury inflation protected security, TIPS, you're going to make a bit more money and you're going to be able to get that money out when you need it. We have to consider our risk. And inherent with this is how does risk and time horizon play together? That's not just how risky the stock is, but how the distribution of the portfolio is diversified as well. Now, most importantly, the habits. It all starts with you. We need to treat you like a business. You need to understand the money in and the money out. You need to have a budget. You need to be disciplined. You also need to enjoy yourself. You need to spend with a high ROI. You need fun and enjoyment. Life is for living, not for being a miser and waiting until you're retired. Because let me tell you, that day will come and your regrets will be that you didn't enjoy yourself more. So let's take a data-driven approach. No gut feelings, no maybes. We're going to be looking at numbers and using logic and being pragmatic. We're going to overcome our emotions and we're going to put systems in place that help us live our life without worrying all the time, but still having the confidence in the money we're invested in. Most investors want to build confidence before clicking buy, but they don't know exactly what to look at. So if you're tired of trying to sift through the noise and the hype in the market today, follow along and let's build wealth together. I'm going to have a couple upcoming videos cutting through the noise on the SaaS-pocalypse and looking at the fundamental metrics we need to assess for companies. In the meantime, buy quality and invest with intent. Thanks.